Hello and welcome back to the Dual Use Tech Summit. I'm Laura Winter. I'm the editor and host of the DownLink podcast. It covers the intersection of space, the space business, and defense. And in fact, check it out wherever you get your podcasts. But for this segment today, I am honored to be joined by the chief of the Defense Innovation Unit Space Portfolio, Bucky Butow, and by George Pullen. George is the chief economist and co-founder of MilkyWayEconomy and is also an economic facilitator to the Space Force Futures Workshops. Gentlemen, thank you so much for joining me.
Thank you.
Thanks for having me, Laura.
Now, you both are well known in the space community, but we're speaking to a larger generalist audience today. Let's give our viewers the chance to understand a wee bit more about your roles and how you fit into this space and defense mosaic. So starting with you, Bucky, you lead a double life. You're a major general, a pilot, and you've deployed more than 10 times, beginning with Desert Storm. Briefly give us an idea of what you do in uniform and then what managing the space portfolio for the Defense Innovation Unit actually means.
Sure. Well, I've spent more than 25 years as part of the Air Force in Air Combat Command, doing a mission we call personnel recovery, and includes combat search and rescue and other extremist types of missions, ranging from civil search and rescue out in the ocean and other extreme environments to hostage recovery, and so it's a very niche part of the combat and special operations forces. But relative to this conversation, big time user of space. So in lots of different ways, from communications to intelligence and imagery, to precision navigation and timing. So I've spent my entire career learning how to use the space to make my mission better. And then in my role with the Defense Innovation Unit, as a director for space, our job at DIU is to accelerate the adoption of commercial technology and to do so with focus, speed, and scale, so that we can achieve strategic outcomes, which is very, very, very important in today's hyper innovative world, where even our not just our near peer adversaries, but other state actors and non-state actors can use space more easily today than they could 30 years ago.
And George, you're very much a Renaissance astro advisor. And yes, I did just sort of make that up. But you're also a book author, Fifth Industrial Revolution evangelist, a Marine. And you also put your money where your mouth is. You're an investor. Briefly explain what you do at that intersection between the space economy and defense.
Sure. So in nowhere near the same way that Bucky has amazing hats, I also wear multiple hats, as you've alluded to. I have several teaching appointments where I get to educate young people on space industrialization, deep technology. I also have a teaching appointment with Columbia in addition to Franklin Pierce Law School. So I also get to teach lawyers about technology and economics. So I get to teach fish how to fly. And then I do enjoy writing. I've done several books on my own and with partners, and contributed chapters in editing for, I think we're coming up on 12 soon this year. So I'm really a big fan of deep tech in general, and of course space I view as a part of deep tech. In terms of what MilkyWayEconomy does, it is a partnership. We provide boutique economic and financial services to companies that are small and medium size within deep tech, space in particular. And then also as our partnership, so MilkyWayEconomy, the partnership, we have a number of investments we've made. We've made over 24 investments. That's our own money. This isn't VC, right? So we're not LPs and GPs and that whole world. This is our money that we put out there. Our check sizes are 5 and 6 figures. So when you're looking for 7, 8-figure checks, please don't call me. That's not my market. But we do put our money, albeit small, where our mouth is. And yeah, I'm just really excited to be part of this conversation. I've enjoyed previous panels that I've done with Bucky and yourself. And so I'm thinking this will be a lively one.
Fantastic. I brought you both here because I know that you're both heavily involved in new space companies and how the capital flows to them so that they can keep doing what they're doing and developing technology for our national security.
Mhm.
But here we are, a year after the failure of Silicon Valley Bank. So I see it as an opportunity to take stock of what has been learned and share it with a wider audience, because we have been recently and perhaps even rudely reminded that America's strategic competitors continue to put their national treasure, their capital, into developing their military space capabilities with urgency. As an example, while Russia's nuclear anti-satellite weapon has grabbed headlines, right? In December, China placed a very powerful optical remote sensing satellite into geostationary orbit. It's called the Yaogan 41. And according to reports, it's being used to identify and track car-sized objects in the Indo-Pacific region visually from roughly 36,000 kilometers away. What that means is that a stealth B-2 bomber can't actually hide. And again, it takes a lot of capital and money to do that. China and Russia have command economies. But in the United States, we rely on partnerships with the commercial sector to conceive, fund, and develop new technologies that are required to defend our national interests. And that partnership is kind of like a balance between public interests, that's the taxpayers' money, and non-government investors, that's private as well as corporate capital, venture capital. And it's kind of worked well, right? Or at least everyone thought so until the Silicon Valley Bank failure. So, George, you were in the trenches when that bank failure occurred. Just to refresh everyone's memory, can you briefly explain what happened and the immediate effects it had on the space companies you work with?
Sure. So on a cold, blistery day in March, the phones last year, the phone started to ring.
It's a dark
And
novel.
yeah, it's the beginning of a very dark novel. The phone started to ring, and on the other end of the phone were companies, NVCs that we work with. We're all friends, saying that their money was tied up, that they didn't know if they were going to be able to make payroll because of what was happening at their banking institution. Now
They weren't actually able to get into their bank accounts, right?
No, they were not actually able to get their bank accounts. Now we should take one step back and just do the Professor Pullen Econ 101 here real briefly, right? So banks make money by taking in deposits and then loaning out that money. Okay. Now they also offer a lot of services and they charge you fees if you overdraft, but generally speaking, that's how they make their money. Okay. And it's not in the bank's best interest, any bank, to have a lot of extra cash on hand. It makes more sense for them to keep just enough liquidity that they're required to keep. So when people come in and demand some of their deposits back out for payroll and the like, that they have it. Now, unfortunately, we had a number of things happening all at the same time. So the market was already pretty jittery. It's important that we remind people that the collapse of FTX, which also was very much a tech and very much a California phenomenon, had happened just a few months prior in November. And so the people were already nervous. And then when Silicon Valley Bank started showing its stress and, of course, its eventual collapse, people's spidey sense was already at 10. And so as things contracted, there became a combination of 3 different things happening at the same time. So the first was that people who banked with them, so these are small space technology companies and some of the bigger and medium-sized space technology companies who banked with them, could not access their bank accounts, couldn't access their funds. Okay. The second thing that happened here is many VCs, also tech VCs, also use Silicon Valley Bank for their banking. Okay, so now you have a situation where even if you had a portfolio company that was in trouble and maybe needed a quick bridge loan, well, you were also in a position where you have access to your capital. So both those things are happening at the same time. And then the third thing is, like I mentioned, there was some hangover still and some nervousness from FTX a few months earlier, but also many of us were in these chairs or slightly different chairs in taller buildings instead of in my home office. 10, 15 years ago, we remember the last time banks started to collapse and cascade. And so there was a great deal of worry about contagion. And so with all three of those things happening at the same time, it's easy now to look back a year later and say, hey, look, we turned out okay, didn't we? Question mark. But in the middle of those nights in March, that is not what it felt like.
And what did this failure actually, now looking back, reveal to you about the resiliency of the current system we use to deliver, the new space technologies and capabilities for defense?
So I'll
And
tee
Bucky,
some
you
of
can
that up.
jump in too.
Yeah, I would tee some of that over to Bucky's side, but I think one of the things that revealed to us is, when we're engaging with these companies, and one of the things has to be, who's your secondary and tertiary banking partners, right? I need to know that you have second and third options if a situation like this should ever emerge again. There was definitely concentration risk. So we had too much of our industry revolving around this one entity. And so while our financial power and our economic strength can be our greatest asset as Americans, American industries, if we don't make sure that we have some sort of diversification, it can also hurt us. And in this instance, it hurt us. The other thing was we found out that the backstops were in place, the new rules were there. So, depositors were made whole, people that have access to their money after a few days, although everyone was holding their breath. So the system did work. And so I think the regulations in place showed that they were able to handle the situation.
So I'll start with a quick story, something that few in the space community probably know, but and it's not really on my resume, because when I graduated high school, the first job I had was banking, and I worked for a savings and loan.
Wow, I never knew
in
that.
California during when the savings and loan collapse happened. If you remember back at that time, Franklin Fund, they had all these new high risk, high reward investment funds had appeared. So all the money were leaving the banks and the savings and loans. They just took that money, like George said, and they wrote mortgages. They weren't really diversified in other things. So how safe was that? And it was federally insured, but it didn't matter when one savings and loan collapsed. There was a run, and I remember the 20-year-old something, version of me getting tasked to drive to Wells Fargo and bring back a bag of cash because the bank did not want to tell people they didn't have bank cash to give them money if they wanted to withdraw it. And
I've seen that scene in It's a Wonderful Life. That was basically the scene.
Exactly. So the interesting, and the reason I say that though is because any kind of disturbance of the force in a financial sector, it can spiral out of control very rapidly. And I had seen the first hand of that. Now I said we're a scene setter, cold day in March, and I'm actually driving out to see a space launch with I had John Olson, who's also a major general in the Space Force, and another friend who fortunately is one of my lawyers. So driving out to see the launch, and we got there and we're all excited. It's because we work with both the launch company and the satellite company that's riding on the launch, and immediately start getting peppered by questions because the same thing. We don't know if we can make payroll. We don't know what this means. And so these are like good companies, right? They're not like fly by night space startups, and so we started. I was on the phone most of that day, and this is I think this was like a Saturday morning now. So the amazing thing is that like most of the other, I'll put in the plagues that we've been riding through. including COVID, that have tried to derail this fledgling, economically nascent industry. By Monday, it it was survivable. And I think that speaks to the resilience that George spoke about. Um, banks are not interested in watching other banks collapse, and neither is the government. And so our economy and the security around it is very important. And just to add some real numbers, there's more than 33,000 technology startups across the United States that all had their money in Silicon Valley Bank, and between 400 and 500 venture and other investors who did the same thing. And of course, the first thing people on Monday morning are like, "Well, geez, what's wrong with these people? They all put their money in the same bank." Well, it's because banking, like all other parts of the economy, they have a target market, and you try being a high tech startup and going to a traditional bank and trying to get loans or services, even get debt equity to buy space things is nearly impossible. And so Silicon Valley Bank for many decades, literally, has been there to provide the type of financial services for the tech sector. And I think the good thing that's probably happening on the backside of what happened last year is that we need more diversity. We don't need the big traditional banks to be financing the early stage space sector. That probably won't work out very well because they're not really well poised to do it. But certainly other competitive parts of the banking industry that can provide these services. But I think it's a more compelling issue, which George can probably talk to, which is how and when do we normalize the space economy, the new space economy, with the rest of the financial sector? Because you could have the latest plague. It's just might as well throw it on the deck here. Is this SPAC craze, right? So it's like, why are we taking really, really good technology companies where the government is an anchor customer, and the only way that they can raise significant capital is by doing a SPAC transaction? It is insane, and that speaks to incentive structures. It speaks to actually cultural and communication gaps between the tech sector and the financial sector. And George and I spent a lot of time with others talking about how do we get the pendulum to swing past this point where the financial sector really recognizes what's going on here and can come in and actually, not with everybody, but certainly with the winners, as set them on a path. You can't venture capital fund yourself to being a great company because you won't own it. You won't own the company
Yep.
at the end of the day. You have to have you need to be able to transition to other financial instruments and tools, and George can speak about those.
Yeah, we can. I mean, one of the things that you hit on there, which I think is important, is as Bucky pointed out, it's in no bank's best interest to see another bank go away, right? The competition between banks is not the competition you see what I would call in a normal market structure, right? Because if your bank looks insolvent, if your bank looks like it's about to tip over, even if I'm the strongest bank in the room, I'm adding risk because now everyone's questioning their banking relationships. And so I think what SVB did is it opened up a chance for other banks and perhaps even boutique shops to step in and say, you know what, we can provide some of these financial services. We want to go out and diversify from, maybe they've been in software for a long time, or maybe they've been in other parts of tech for a long time, but now they want to add space to their portfolio. This gives them an opportunity. I also think that it's important to keep in mind that banks got in trouble for another reason, because we went through a period of time where we saw 11 11 interest rate hikes in a row, right? And so when you have 11 interest rate hikes in a row, I don't want to be the guy who just points a finger like, hey, bank, why didn't you do better? 11 interest rate hikes in a row. I'm going to use the word everyone hates using, unprecedented. It's really hard to find times. It's so overused. I'm done with it. But it's really hard to find another period of time where we see 11 in a row in 2 years like that. And so remember, they're taking in deposits and they have an interest rate on that deposit. They're making a loan based on the market rates, right? They have duration risk. And then all of a sudden, well, interest rates are moving and they're moving and they're moving and they're moving. And so it makes some instability in their balance sheets. And then we're going out and telling them, hey, you know what we also need to do? We also need you to offer financial services and products to some of these really risky companies. They're trying to do the next big thing in tech or in space. Not super appealing to the people who have to manage the risk of interest rates swinging that quickly. So there was a lot of stresses there. But I think we did overall respond well to it. And I hope that what we find out in 24 as we move through 24 is that it's opened up an opportunity for other banks to go into these markets and provide services here that weren't before. I guess we'll have to wait and see if that happens.
I think that's a great point that you bring up, George, because it's not like the board and all the executives at Silicon Valley Bank were off doing crazy things, and it just it's really a perfect storm. And at the core of what we're talking around is risk, right? And how we manage risk. And great companies are the product. Disruptive companies are basically risk takers. And if you never take any risk, you're not leading, right? And so having the capacity, not just on the government side, economically. Economic security drives national security is foundational to it. So you can't be a world leader in space if you're second rate at financing and building commercial space technologies. It does that's not consistent. So fortunately though, I think we did avert a disaster. A lot of kudos to the people who made that happen, and there will be other challenges down the road. There always are, and it makes us think differently too about on the government side. How do we make sure that we can? What are the things that we can actually do to help these companies? Like during COVID, we were a letter writing machine. We didn't have to spend any money. We wrote letters, and those letters said these companies are important. They need to be able to keep their factories open and working during the pandemic, and they did. And imagine a rocket company trying to do remote work. It doesn't work. It doesn't happen, right? So but that's why we have organizations like DIU and the Space Force and NASA and we are all partners together in trying to make sure that we're delivering the best capabilities and also trying to go after these dual tracks of commercial and national security, which works out really well for us.
I think there's another part, if I can, Laura, and then I promise I'll stop talking. But there's another part there of the funding structure that Bucky hit on that makes me want to talk about it, which is after we saw both economic conditions change and our risk tolerance, right? Because we all got a little spooked, change. We did see the venture and the private equity community pull back. Right. And so there's some great statistics out there. Bank of America puts them out, McKinsey puts them out. But no matter how you slice it, VC fundraising went down by about 50 or 60%.
I'd say 60% at least, because if we're talking about a comparison between 2023 and 2021, 2023 saw 19 billion invested globally, according to Space Capital, and that's a market difference from 30 billion that was invested globally in 21. Yeah.
Although
I mean,
21 was a pretty banner year. That wasn't the benchmark, but actually,
but still, that's a huge decline. I mean, that's massive.
It is, but there's other factors in that too. Over the past 10 years, investors have become smarter about space. I mean, it's like when when we first started working in space, the demand signal for a launch, low cost launch, was so strong, and that's why you had all these launch companies. It's like there's like
hundreds.
a bigger dozens and dozens of mostly PowerPoint launch companies, but launch companies nonetheless, and really only about between 6 and 8 like real companies that are like building things and launching things. But those demand signals are really important to get right. And then the other side, as a responsible person on the government side, we can't treat economic things like it's AYSO soccer, right? Like every kid gets a trophy, right? No, it's not like that. Only the best performers get it, and it's got to be competitive. And government should not perturb the market. We should be. In fact, it's our national defense strategy. One of the core tenets of the national defense strategy is that we're going to fast follow commercial innovation, right? And that means letting the market help decide who those winners are. And if we have some unique thing that serves a government purpose, that's different. But generally speaking, that's our defense industrial base. But it's important to really focus on the best performers, and that sends a good signal also to the financial markets that we recognize where the talent is, right?
I want to jump back in here and kind of turn our heads back to risk. I don't think anyone can argue with the idea that, the best performers should win out and should get the prize, and that it isn't AYSO soccer, though I did play and I love AYSO soccer.
Mm-hmm.
So, but when this event happened, right, when Silicon Valley Bank, did fail, and speaking with guys, like you, Bucky and George, you guys show me the way, because I'm admittedly not the smartest person when it comes to banking and venture capital acquisitions, rapid adoption, right? But what really surprised me was how a bank failure revealed opportunities to our strategic competitors to scoop up what should be U.S. sovereign intellectual property, that technology. I mean, even before it gets into the competition and goes for that prize. Could either one of you, because I really like for the audience to also understand, what the other side of the risk is for, the current capital way that we do things, explain to our audience the asymmetric risks, because, and obviously without naming names, but, I've heard stories, and mostly actually from you guys.
Mm-hmm.
So,
go ahead, George. You go first.
So I'll go first on this one. So my concern, right, and either this is the Marine teenager in me, or this is the Patriot in me. I'm not sure which one, but my concern, the thing that keeps me up at night, cleaning my rifle, is I worry that sometimes there could be a disconnect between the best technologies and the best firms. Because if we think about finance and economics, that's not the same as engineering and manufacturing. So I can have a dream team of engineering guys and gals, or people working on a bench building things, but they don't have their finances in order. And you could have a technology that gets shelved under those situations because we haven't provided all of the financial tools that are available. And I'm not saying we need to invent new financial tools. We have plenty of them that exist in other markets. We just need to make sure they come here to space and that we're using them. Because I don't want to see technology we really need get shelved because someone tried to build their own version of QuickBooks and they don't run their business well, or they do a bad job at a pitch deck. Like those aren't skills that give us military technologies or dual use technologies.
A couple of years ago, when we every year we sponsor a workshop called the State of the Space Industrial Base, and we're about to release our report for last year 23, and in previous reports we survey, and we really give the industrial base, the tech sector, a chance to speak. And it's not just a bunch of talking heads like me and George. But the interesting thing is, so when we first asked the question, I said, how many of you are using debt financing? This was like 2 years ago. And it was like, there's like one. There was only like one company that was even, entertaining it. And the others hadn't even really thought about it. And there's space companies that have raised, series E, F, and G. And it's like, that's not healthy. But trying to unlock those other financial instruments is so important. And that's an area where the government can help incentivize things. And you know what? We lower the risk, the temperature of risk significantly, because here's the one thing that's a consistent theme, or two things that are consistent in this thing. One is diversity, and the other one is resiliency, right? So you can't have resiliency without diversity, right? So it should make you very nervous anytime you see a monopolistic. There's only one bank, there's only one company, there's only one whatever that's driving all these things, and it's probably really good for that bank or that company or whoever that's got that monopoly until they stumble, and there's a lot at risk there. We have an amazing financial sector in our country, and you can go and swing a long rope in Manhattan and probably smack a bunch of ivory towers that represent the greatest banks in the world. There's not just one of them, there's lots of them, and the interest in their what it competimates or whatever you want to say. I mean, those banks, they're in it to win it, but they're also they're in it to make sure that their sector stays alive and well. Telecom's the same way, right? So you don't have just one AT&T, or is not like the sole provider of all mobile telecom. And
Thank goodness.
well, exactly. And you can make an argument that T-Mobile, who was like nobody, could be like everybody, and because so that diversity drives competition, and that competition is healthy, and so it's really, really important that we find ways to do this in space as well, and we are. My job, if you ask me what my job is really today, is two things: write checks and build benches, right? So or build a menu. So if you say, hey, I'm interested in a company that can do remote sensing from space, I go, okay, here's like 3, 4, 5 winners, and we've worked with all of them. And because I don't do acquisition, and if acquisition people do acquisition, and acquisition people want menus, they don't want you to say, well, here's the winner. You go, you're not an acquisition guy. What are you doing? That's my job. So my job is to build a menu and to identify great companies. And so investors are like that too. They recognize it's really how the venture model really works is you can afford to take some risk because some percentage of those companies are going to be off scale winners, unicorns, right? And that's how that system works. And look at the unicorns we've had over the past half century. That's been really amazing. The other thing too, which I think is really important, space is going to be a significant contributor to our U.S. Gross national product or gross domestic product in this century, and I mean like a major one. All of digital finance, all the things that came out of the internet, that's like 10 point something percent of our GDP today. And if 30 years ago, if you said, hey, this thing that you use to look up a restaurant or a paper at UC Berkeley is going to be 10% of the GDP, people will laugh, right? Because they couldn't see it. But space is going to be like that. Space is going to be one of the big double-digit contributors to the future of the financial health of this nation, and it hasn't had that moment, but it's on its way there, and we recognize that. I think the financial sector realizes it. We just have to make good decisions to make sure that the U.S. is first and stays in the lead.
I'd question one thing. I think we all recognize it, but that's also because we're in the space community, right? I hate to say that, but I'm just going to push back on that just for a quick second. I'm not sure that the entire financial sector recognizes it. And if they do, I mean, sure, Morgan Stanley did write that report saying, that the space economy is going to be worth, $1 trillion by 2040, when it's probably going to be worth $1 trillion before that. But if the financial sector was really recognizing that space was going to be such an important factor in our national economy, and in fact, in the world economy, then why is it so hard for space companies to interact with other banks besides Silicon Valley Bank, right? If they see it as important, how can we get those other banks besides this one single bank to then provide those tools that are necessary and to be willing to take that risk, because space is risky? And George, you're my banker, sort of, kind of banker, past person. So you go for it.
Well, so there's a couple of things there, right? So I say the first thing is, let's look at the way the markets function, right? I mean, we have to remember that we're talking about a world economy, or even if we just want to talk smaller, just the U.S. economy, worth hundreds of trillions of dollars. The world economy is measured in trillions of dollars. It's $110 trillion right now, or something along those lines. And so even if we're looking at space economy estimates, I prefer mine to Morgan Stanley. I say 4 trillion by the 2040s, but be that as it may. But if you look at that number, or look at the Chinese Space Agency's number, right? They say 10 trillion by 2050. Okay, so look at those numbers, but then keep that in mind with the size of the global economy, right? So you're still talking about a contributor, perhaps a critical contributor, but in percentage terms, it's not going to gather the same amount of attention that, say, oil and gas does, or telco does, or farming does, right? It's not going to capture that same amount of attention, and therefore it's not going to capture that same amount of banking relationships, that much of financial attention and the like. I think that what's important for us to look at is, how have we seen this evolve other places, right? And so the easiest one to do is look at tech. How did it happen there, and how can we have something similar happen here for space? So if we stop and look at what happened there, we saw a number of early companies coming out of World War II, as we slowly entered the Cold War, that were receiving large amounts of research, and they were closely located to research universities producing very high-end technology that benefited both the use of the Pentagon and the use of the commercial sector. And then as that progressed, those companies had the opportunity to make money, right? So they went public, etc. They merged with other companies. People had the opportunity for liquidity, because if you don't give an investor liquidity, which means they get their money back, they can never put it in another company. Okay. And as that happened with tech, you develop this whole culture of, oh, I was a Googler, right? Or I was Amazon employee number 82, or whatever it was. And as they went through the steps, they then themselves became entrepreneurs or investors in the next generation and the next generation. That's what happened. We haven't managed to do that with space. That's a problem, right? Because if you look at the early space companies, and Bucky made a good point here, where did those early investors and those early entrepreneurs find their liquidity? With some SPACs, right? And I'm not going to be the 18th person to pile on to how bad most SPACs performance have been, but you can pull up your own data. You know how bad they've been. And so when that happens, you don't create this living, breathing financial ecosystem that says, okay, I had some real winners last time in this sector. I'm going to put money back into it. Because while we all are always going to be enthusiastic about technology and space, we have to remember that my dollars, they compete. So if I see something amazing happening over in AI, or in biotech, or in blockchain, my money might go there instead, right? Because it's not just, I made my money in space, it stays in space. It's also the money I have has to compete with these other technologies that are tip of the spear that might be in my same interest group. And so because we haven't seen those early tech pioneers have big wins, have successful exits, and then move on to their second or third companies, or start their own VC firms, we haven't seen this ecosystem take off, right? And that's what we're missing. We need to really study what the economic and financial models were that made that happen for tech, and try to duplicate that here.
So part of the government innovation process that I'm a part of, somewhat laughable. Similarly, like with George, I'd encourage you to just look up, how many banks, lost everything on that FTX fiasco, which was around, cryptocurrency. It'd be like there's no anchor government customer for cryptocurrency. There is a well-defined anchor customer for space technology, and the amount of money that the U.S. government is put in, SpaceX would not exist, without transactions of the U.S. government, especially the Department of Defense and NASA. So, um, so we're doing our part, and we are very conscientious about that, and that's what you would not be surprised. You would hopefully expect that there's a lot of collaboration on the government side to make sure that we get this right. You don't have to go back very long ago to see collapse of companies like Solyndra, right? And understand that, you can want, solar power all you want, but you can't defy the market, right? The market is the market, and you will succeed or fail based on the market forces, not government forces. And so for us, it's really important, and that's like at the core of what DIU does and how we do things is we identify problems, not requirements. We identify what's a problem we're trying to solve, and we go to great companies, not just in space, but across all sectors, and say, tell us how your commercial solution can solve this problem. And in selecting those companies, we don't just look at the technology; we look at the team. But more importantly, what's the commercial viability of this product or service, outside of the defense context. And there's some things, the first thing that we did was commercial synthetic aperture radar small sats, and there was absolutely zero U.S. industrial base for that, for commercially, and so we had to create a commercial sector where there was none, and that it's paying off now, but that wasn't very that was kind of high risk, and we needed to address, well, what are all the commercial markets for that beyond day night all weather imagery, and a lot of it was asset management. It was all kinds of other unique things, and surprise, surprise, it doesn't matter. All the best remote sensing companies in the United States, they have a healthy amount of commercial market is offshore, doing agriculture, doing other things, and NOAA they license the technology be used that way, because there's no commercial company develops for a domestic market only, right? They develop for a global market, and that's the exciting thing. If you want to see things scale, they need to be able to scale and take advantage of that market, the global marketplace. And so there's some risk with that, because then you're democratizing technology. But really, I think you could say, well, yeah, the banking sector, and I think it's also important to clarify that, yes, Silicon Valley Bank did fail, but it was a graceful failure. Because 33,000 companies that will define the future and fund your 401k, and 400 to 500 venture firms that actually build those companies didn't disappear. That would have been, you would know that I'd be selling apples on a street corner on the other side of the freeway overpass right now. I wouldn't be sitting in my Gucci Silicon Valley DIU office talking to you two, because that would really have led to a financial collapse. It would have been really epic. Right. So we have institutional mechanisms, and they will become better and stronger, and the diversification is where we really need to look at. And we can't government mandate that, but certainly the sector is going to look at that. And actually, the venture community is pretty articulate in what they need from us. They've been very consistent, which is meaningful contracts. You just say, if buy what you say you're going to buy, and buy it, scale it, because in the last decade, we've seen some close to $300 billion invested in the new space arena, and it'd be nice to say that we've got like $1 trillion worth of business transactions to basically reinforce that, but it hasn't gotten to that level yet. But it will in time, and I think the amazing thing is the cost of launch dropping. The access to space. There, in the next couple of years, the three of us could form a space company and never have to build a satellite, because we could do it. We could be a software company and providing great services in space. And that's really the dream. Jeff Bezos said that he couldn't build Amazon if not for the financial digital finance, the overnight delivery, and the internet, which is all infrastructure. And if that infrastructure didn't exist, he couldn't build his business. And that's there's the most significant. The Googles of the 21st century are going to be built on space infrastructure, and we don't even know what those companies are yet. But that's what's at stake if we're not bold. If we're not, but in being bold doesn't mean being stupid. And we make sure that we build this economy, so we continue to be a leader.
Gentlemen, we've run out of time. Bucky, George, thank you for joining me today for this segment of the Dual Use Summit.